The moving average convergence divergence, MACD, is one of the simplest and most effective momentum trading indicator which can help you identify potential buy and sell points. The MACD usually appears as a separate chart below a stock chart. The MACD line chart is displayed as two lines. In this chart, you will see two lines, the MACD line which is blue and the signal line, pink. These two lines oscillate crossing back and forth over the zero line. This video will start with how you can use MACD for high probability trading for profits. Later part of this video will explain detail about how MACD and the signal line are calculated, so you will get better understanding of MACD indicator. First, look at the MACD line itself. It is an oscillator which moves above and below the zero line. In any chart, when you click to show MACD line, it was already automatically calculated. You don't have to figure out how to calculate the line. A signal line is created with a 9-period exponential moving average of MACD line. Generally, when the MACD line moves above zero, this means the market is gaining upward momentum and considered bullish. When it moves below the zero line, it is in downward momentum, bearish. When MACD turns up from below zero, it is considered bullish direction ahead. When it turns down from above zero, it is considered bearish direction coming. Usually trading signals occur when MACD line cross the signal line. For example, a bullish crossover occurs when the MACD crosses above the signal line. Some investors may consider this a buy signal. On the other hand, a bearish crossover occurs when the MACD crosses below the signal line, and some may consider this a sell signal. Stronger buy signals occur when the MACD line is well below the zero line and turns up to cross above the signal line. Also look for candlestick bullish signals. If you like to learn about basic candlestick charts, please review my other previous videos. You have more chance of winning if there are bullish candlestick signs such as the hammer, dragonfly doji, bullish engulfing candles at the bottom of a downtrend. When the MACD line crosses from below to above the signal line, the indicator is considered bullish. The further below the zero line, the stronger the signal. Confirmation of buy signal is when moving averages cross above the zero line. At that point, you may want to start buying or add more positions. When the MACD line crosses from above to below the signal line, the indicator is considered bearish. The further above the zero line, the stronger the signal. Also look for candlestick bearish signals such as doji, hanging man, gravestone or shooting star at the top of an uptrend. However, using the MACD indicator alone doesn't always give a complete picture. Another component of the MACD indicator is the histogram, which can help you predict future crossovers. The histogram is a bar graph which shows the difference between the MACD and the signal line as a bar. If the MACD is below the signal line, the histogram has a negative value. When the MACD crosses above the signal line, the histogram displays a crossover and became a positive value. Difference between the MACD line and the signal line is bigger, the histogram is bigger. Difference between the MACD line and the signal line is smaller, the histogram becomes smaller. When the MACD and its signal line have the same value, the histogram is zero. When the histogram goes from negative to positive together with the MACD crossing above the signal line, pointing out the market's bullish turn. When the histogram goes from positive to negative and the MACD crosses below the signal line means the market will turn bearish. Sometimes, waiting for MACD crossover might be too late to act. You can use the histogram to anticipate a MACD crossover before it occurs by watching the slope of the histogram. The histogram has been rising and then it starts to fall, it might signal a negative crossover could be happening soon. The histogram has been falling and then it starts to rise, it might signal a positive crossover could be coming soon. The histogram is an important indicator and can give you early sign of the market direction changing, so you can either enter or exit the market on time. Here is another important thing to pay attention to predict a market direction. Difference between price action and MACD indicator. Divergence between the MACD and the price action is a stronger signal when it confirms the crossover signals. For example, the market price is still rising in the uptrend but MACD is turning down and an histogram is falling. That indicates that the price will fall very soon. An end to the current trend may occur very soon when the MACD diverges from the market price. A bearish divergence occurs when prices reach new highs but the MACD is turning down. A bullish divergence occurs while prices are falling but the MACD is turning higher. Both of these divergences are most significant when they occur at relatively overbought-oversold levels. Also look for bearish or bullish candlestick signs. Please keep in mind, the MACD crossover can be late to identify buy and sell signals because it is calculated exponential moving averages that use historical data. This can cause a lag between the current price and a buy signal in the chart. So the histogram plays an important role to see future MACD crossover right around the corner. You need to review all available indicators. Just only one indicator is not enough to make a decision. Now, let's see how MACD is calculated and what it means. The MACD is the relationship between the two moving averages, the difference between a 26-period and 12-period exponential moving average, EMA. It is the measurement of the divergence or convergence between two moving averages. The MACD line can be calculated by subtracting the value of a 26-period exponential moving average from a 12-period exponential moving average. The shorter moving average moves more quickly. The shorter exponential moving average line is moving converging toward or diverging away from the longer EMA. That's why it's called the moving average convergence divergence. The MACD oscillate above and below the zero line as the moving averages converge, cross and diverge. MACD is comparing a recent price movement to its longer-term price movement to get a better prediction of the market trend. The signal line is 9-period exponential moving average of the MACD to show bullish and bearish signals. I hope this will help your future winning trades. Please subscribe my channel for future videos.